one doesn't even know if they're going to wait until later, or have they really put the doors shut as far as the rate cut is concerned. But Jayesh Mehta is with me, and Jayesh, the contrary question, I think both Swami and Dr. Sen have put it out in the public discourse, and I think so did Maithili briefly, that the scope, the ball has been left in the court of banks to say that banks should be cutting rates, and they've reduced lending rates due to demonetization. We're flush with funds right now, but the fact is, like it's been pointed out, that MCLR is going to go up, and that is not going to leave room for a rate cut. Quite the contrary, it may make and pave way for a rate hike. Jayesh Mehta?
Yeah, I completely agree with Dr. Sen, because if you say the MCLR rate cut came because of demonetization, where excess deposit came into the banking system, and now if you are going to remonetize it, and if the banking system deposits are going to get reduced and the liquidity gets reduced, that definitely will push up your MCLR rate. Without any other action, will definitely push up your MCLR rate. So I am also kind of confused as to when you say that, okay, your rate cut happened and MCLR was down because of demonetization. We understood huge deposits came to the bank, but as the deposit goes out and the cash withdrawals happen normal, that is going to go out, and that's where the MCLR will go up. So this is right now with the ceilings. Once the ceiling goes off completely on withdrawal, your liquidity, which is so much surplus in the system, may not really remain. So I think that is a little bit confusing as to why they are saying that it is still room to cut rate, because now as we are opening up, we opened up the current account limits to unlimited, and maybe we slowly by 28th February or something, we are opening it to 50,000 a week, and then by 13th March we are making it fully open up. So that is in a process to reduce that. So that's a little puzzling there. I think on the overall rate situation, yes, it is an uncertain world today, and yes, one can have a view what is happening globally, but the views, as they pointed out, always was worry. Even if you cut rate tomorrow, in 10 days, 15 days, your next policy is 2 months away. In 20 days, oil can, if something happens globally, and the shocks are always there, and if oil goes up dramatically, you would have to change your stance, which is always a worry. So at this juncture, taking a call saying that oil is a worry, yes, it is worry, but does it really changing it dramatically? Not so. Secondly, the same point, as in we always talk about the 7th pay commission, that's still there, and I think one of the points they did mention about, yes, there is global uncertainty, and therefore the flow is going out, and therefore dollar strengthening, right, and therefore weakening of currency in emerging market and maybe also India. That can push up inflation. Jayesh. But these are all, as of right now, you see, it's right now all about view. So as and when the action happens, that's when you will know. So yes, maybe you can say I'm neutral, or I'm not doing anything, Jayesh, because I'm uncertain about the things, but uncertainty is one part, and being biased on one side is different part.
Jayesh, I must ask you one question before I go back to Soumyakanti Ghosh and Pranab Sen as well. From a rupee point of view, do you believe the appreciation in the currency and the need to rein that in played on the mind of RBI? Because if you look at yield curves, they were flattened. What does this policy really do to the currency, the yields from that point of view?
No, I think it did react, and you see, of course, there was a dollar strengthening view, and therefore softening of all emerging market currency, including India, but India didn't get affected so much. And if you look at last 10 days, 15 days or so, it's been the other way around, where dollar has been softening, and therefore the emerging market has been appreciating. But with that statement, that caution by RBI, that appreciating rupee, it does not really help, because as of right now the market is in, and nobody really knows like what's happening, what's going to happen, dollar strengthening, dollar weakening. But if we are saying that okay, dollar strengthening happens and therefore our currency can depreciate, and that brings in inflation, that would kind of, I would say, if tilt a little bit bias as to, yes, even central bank is acknowledging, and they won't do anything if there is strong dollar strengthening happening, so they will not resist the situation. So that's the mindset would come into the minds of the people.
Dr. Pranab saying the whole idea and the whole discourse around this credit policy was, will it lower rates to boost consumption? That's a very simplistic argument, but for the sake of it, I'm going to make it. Do you believe the policy in some sense has snubbed the need to boost consumption, has in some sense, and I'm not going to get into the whole discussion about why investment is not happening because corporates are over leveraged, they're sitting on huge capacities. Let's put all of that aside for a while. Let's just talk about simple consumption. Does this policy snub the need to boost that simple consumption, if I may?
Let me be very clear. This policy, in terms of the actual monetary effect, is going to have no effect whatsoever. Monetary policy continues to remain broke and will be so till such time as a reasonable amount of remonetization has happened. So in terms of what you're doing in this policy spilling over to either investment or consumption, forget it, it's not happening. The important thing about the policy this time around is its signaling value. And what is it that you are signaling? That's the question you should ask, because consumption is going to continue to be held up by two things. One is the availability of cash, and the second is the damage that has been done to livelihoods in the informal sector. Nothing in the monetary policy is going to change that. You're not going to see greater consumption loans happening. So let's discuss this monetary policy as not something which will have an effect on the real flows of money and capital, but in terms of what signals are being sent to the economy at large.
So would you agree with that assessment, Vaidyanathan? Well, we join now with Mr. Vaidyanathan. So my question really now was to Mr. Vaidyanathan, saying that Dr. Pranab Sen said that this policy must be looked at not for what it does in terms of real flows, but what is the kind of signal it's sending to the rest of the economy. So would you concur with that assessment, and would you agree with RBI that a neutral stance is the best stance for the central bank going forward? Vaidyanathan?
The first comment on consumption, whether there is an impact on consumption, to the previous question. Certainly, I believe that the installment per lakh of loan for a housing loan, for example, to take it as a benchmark, was 1,000 rupees just until 5 or 6 months ago. It's less than 800 rupees, 770 or 780 per lakh. So that's 200 rupees per lakh of loan per EMI is a reduction. That's a 20% reduction in EMI. I do think that this will leave a lot of money in people's pockets who have already borrowed loans, for example, will make borrowing easier for people wanting to borrow loans, particularly in affordable housing. The PM has now announced subsidies of 3% and 4% depending of the loan amount being up to 9 lakhs and 12 lakhs. I think these are substantial things, and I think therefore we should look forward to improvement in consumption. And mind you, even during this demonetization, barring the month of November, December and January consumption is coming back quite strongly.
Well, we're joined also by Soumyakanti Ghosh over here. And Soumyakanti, I wanted to ask you a question. Anshula Khan said that she expects that about 50% of the CASA deposits will remain. And maybe she was talking in the context of SBI, but even if you look at the larger public sector banking space, if 50% of the CASA deposits remain, even assuming that they do remain, what kind of lending will you do, given what it means for your asset liability mismatch? Because the biggest boost has come for housing. And if you're going to lend CASA deposits for housing, I'm not sure what it does for your asset liability mismatch.
See, there are two things playing out over here. As RBI has said in the policy in terms of the currency restrictions that they will go away by March 13. So a clearer picture of this amount of CASA which could be written in the banking system. As of now, we expect that a large part of that could remain within the banking system. So If that is the case, I think there remains, I mean, as you mentioned just now, there will remain a case of lending to happen more gradually. But as of now, if you ask me that what could happen in the next 2 to 3 months, I think things are still a little fluid. So the assumptions of the currency remaining within the system remains as of now, because a large part of the money which is coming in terms of the CASA deposits has not yet gone out, and if that money remains within the system, I think that will give the banks a boost in terms of the lending capabilities. And I think in terms of the asset liability mismatch, the question you asked, I think that is one thing which the banks are always aware of. So I believe that a prudent decision should be made regarding that asset liability mismatch by the ALM committee.
Alright, SK Ghosh, I know you have to leave. Thanks very much for being with us on ET Now. I'm also joined by Mr. Parthasarathi, Group CFO Mahindra, right here on the channel on credit policy. Thanks very much, Mr. Parthasarathi, for being with us. Your quick take first, because corporate India was cheering and was hoping for a 25 basis points rate cut. That hasn't happened. And not just that, the rate cut has not happened, and the RBI has changed its monetary policy stance from accommodative to neutral, which means that they've shut the doors on future rate cuts. This is the end of the rate cut cycle.
Okay. First and foremost, yes, in a cricket parlance, and this is the cricket season, Dr. Patel has left what was a ball clearly set up to hit a 4, has let the ball go, hoping that there will be future balls which will come, which will be far better to hit, and this is a time to take a pause. And honestly, more the neutral comes as a little bit of a surprise, because I think with the kind of budget that we had, which focused and was designed to be conservative, disciplined, and kept the fiscal deficit under check and the headline inflation what it is, and there are many better people to talk about than me, but the atmosphere seemed to be more accommodative, but the neutral stance is actually a bit of a surprise. I must study the fine print, coming right off a meeting, but I must study the fine print, but that seems to be a little bit of a surprise to me. Having said that, I don't believe this is the end of the cycle. It only believes that there is one more period between now and then where the neutral will have to get back to accommodative before the cut happens. But RBI has always surprised us, as it did this time. I'm sure there will be a positive surprise in the future. But on two fronts, I think there is a very positive liquidity and, sorry, go ahead.
Mr. Parthasarathi, what are you hinging your hopes on for that positive surprise? What are you hinging your hopes on the future balls that he could hit a boundary for?
Yeah, so two or three things. I think part of the boundary is getting hit based on what has already happened, which is demonetization. There is a lot of supply into the market, and actually yields have come off 50 basis points from where they are. The reverse repo rate is working more for the interest rate set rather than the repo rate. So clearly there is a softening. Whatever earlier we couldn't achieve by requesting bank to pass on has been achieved in another sense. So the interest rates are lower in the market. Liquidity for demand growth is not a problem. So this 25 basis point would not have changed anything. But what it would have sent a signal is a little bit of positive energy, which is what we are missing. But having said it, there are many other cues in the market which has come out of the budget which will have to play a larger part. So we wait and watch for those investment and other decisions to play out. So, and let's hope Dr. Patel then looks in future and surprises us with 25 basis points cut in the next review cycle.
My expert panel here believes that perhaps there will be scope for a rate hike instead of a rate cut, but you being hopeful there. I'll ask you a final question. I'm completely running out of time here on this show. The bit that you said, a rate cut would have sent a positive, cheery signal to the economy, would have boosted consumption. Do you believe consumption that was delayed is perhaps not due to this rate cut going to be denied now?
Not certainly. This would have been a feel-good factor which would have come, because due to excess supply anyway, the interest rates were very benign in the market. That's not going to impact. It was more a signal. and I think that will kind of have a little bit dampening effect, but there are many cues in the budget which will positively impact the demand, and I hope we will have a good year end and financial year end.
All right, we'll have a good financial year. Thanks very much, Mr. Parthasarathy, Dr. Pranab Sen, Matthew Basulmat, Swaminathan Iyer, S.K. Ghosh, Jayesh Mehta, and everybody else who's been a part of the stellar show as we discuss and debate the 6 bi-monthly monetary policy. RBI, Urjit Patel have decided to hold on, they've decided to pause, and they've decided to change their stance from accommodative to neutral, which makes a lot of us believe that this is the end of the rate cut cycle. The concern though is the level at which rates are comfortable enough, and could RBI have given itself a little more elbow room. Thanks very much for tuning into ET Now. Stay with the channel for news, updates and expert analysis that continues.